Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday the 18th of March 2022. As always, this is general commentary and doesn't take your personal situation into account. Alrighty, with that said, let's get straight to our first chart. Okay, the S&P 500. Well, over the last couple of weeks, we've been talking about the potential for a short covering rally. So what we've been seeing with the markets trading around down here over the last month, there's been we've seen a lot of volume going through the some of those hedging instruments like the bear market ETFs, the inverse ETFs, put buying. There's been a lot of short interest. So we've been talking about that potential for a short covering rally. And I think we've now got some signs that could be getting underway with what we've been seeing over the last few days. So we've had the Fed come out and hike rates during the week. They've been pretty hawkish about what they're looking at for the next few months with the rate hike cycle. And I think it surprised a lot of people that the market's come out and it's rallied on the back of that. And that's so often what we see because the market gets itself so worked up and so positioned for something that they're expecting to happen. And often when that happens, the market will then reverse course. And that's very much what we saw last week. And it's a really interesting chart structure when we look at this. So what I want to do, I want to go over to a 4-hourly chart. And so we spent a lot of time looking at the daily charts, and daily charts are fantastic. It's also good though to be able to step back and get down into some of those intraday charts like a 4-hourly or even an hourly chart, just to sort of see the internal structure, because you get a little bit more detail and it can help you see patterns and help you see potential setups that you might otherwise miss. Now, there are a couple of key areas I want to talk about. So first up is this bullish wedge formation, which we spoke about. I think we spoke about this last week. So let's just have another look at it now. And so these formations, they often appear near market bottoms. And what happens is you get this contracting price action. The market exhausts itself to the downside and then turns and breaks upwards. And that's what we've seen over the last couple of days. We've got a breakout from this bullish wedge formation. And now, I just want to be clear about one thing though. I'm not turning bullish on this market. It's I think, like, if you've been listening and watching over the last couple of weeks, I've been talking about this correction potentially playing out over the next few months. But what I think we might have here, I think we might have a situation where the immediate vulnerability is past, and now we're about to get some sort of reaction to the upside. And then, look, who knows if this happens, and should it happen, like how long it takes to play out. But then I think we've always got to be mindful that if this correction does take a few months to play out, we could get a rally, and then we could get the second act of a large decline in a few months' time. That's getting ahead of ourselves. Let's just look at where we are now and the potential for what happens over the next few weeks. And one of the reasons I think this short covering rally could be starting to engage is that you just think about everything that's been thrown at the market over the past few weeks. There's been, like, we've had big inflation numbers coming out of the US, like inflation at 40-year highs. Interest rates have gone up this week, and bond yields have been rising over the last few weeks. There's all the geopolitical trouble. We've got a war going on over in Ukraine. Oil spiked up towards $130 a barrel. And we've also seen all these other key commodities spike higher too. So that adds to inflation. So you've got all this stuff going on, yet the stock market hasn't melted down like a lot of people thought it was about to. It's had like 3 tests at really cracking down towards this 4,000 level and below. Hasn't been able to do it. And now we're getting a rebound. So I think the path of least resistance, at least in the near term, is probably setting up for higher. And now I think the first test of this view, which I'm talking about, is to see, look, can the market hold this break? And we're going to find that out over the next few days. And then the next thing will be, can it break above a resistance band? So I'm just going to put some resistance on this chart. It goes somewhere like just looking at a line of best fit. It's something like that. It's around, say, 44.20 to 44.40 thereabouts. Got a resistance band, picks up some work through here, bit of work through here, touches again there, and we're just butting our head. The market's butting its head up against it right now. So this is a key moment to see what the market's going to do. Because look, there's always alternate scenarios. If this short covering doesn't engage and we get a quick move back down, the market could set itself up and re-engage into a sell cycle. That's still on the table. This is by no means the market's going up. It's we've got to be aware of everything that could happen. So that's still a possibility. My preferred case at this stage, I think we're going to see something like this. I think whether we pull back tonight or we go up tonight, I don't know. But I think if we can do this, if the market can get its nose above this resistance band, well then it really sets the stage for being able to go higher and see some more short covering come in over the next several weeks. And when you look, and if we do get some meaningful unwinding of heads positions, I think there's a potential to see this market rally maybe 5 to 10% from where we currently are. So you look, we're here at the moment. A 5% rally would get us up to around here, around the top of this pattern. 10% gets us up towards the previous highs. So somewhere within that band is a possibility for a big short covering or hedge unwinding type of rally. But look, as I've said, I don't think this is a case of go out there and buy everything moment on the basis of what could happen in that respect. Because look, I look at markets like the Nasdaq, and I'm just going to jump back to the daily chart for a sec on this. And look, this is look, the wedge doesn't really appear so well on this. It's very elongated. I wouldn't call this a bullish wedge. The bounce we've had off the low is quite soft. Nasdaq's not looking bullish. It certainly has potential to rally in a short covering rally type scenario, but I'm not about to say, look, this market is turning bullish and we're off to new all-time highs by any stretch. Not at this moment. So it's a case of look, I think we could see some upside, but I'm still mindful of whether this big ABC zigzag could play out over the next few months. That's the sort of scenario which I think we could see. Don't know, crystal ball sort of stuff, coming up with like how a correction is going to play out. But this is, of course, your classic corrective sort of setup. You get the first leg down, you get the move up, sort of like suckers people back into the market thinking, oh, we're back to new all-time highs. We're on, the bull market's back engaged, and then it rolls down, it goes, it makes a new low. Whether that plays out, time will tell. That's very much a scenario which is front and center in my mind at the moment. So let's let's see how the next week plays out, whether we can in fact get above here. Give us some more clues as to what's going on. Let's quickly jump over to the ASX 200, the local market. And this is looking encouraging. It's last week we talked about. Look, I said, the market's got to hold these lows. If it breaks those lows, well, it opens up the window for another selling event, which could take the market quite a bit lower. But look, it didn't even challenge them. We've seen the market punch back up towards its highs from February. And if we do a measured move, what you can do a measured move. So a measured move is using a previous low, going up to sort of like we call it a swing high, coming back down to the low point for the reaction down from that high, and then you project that higher. That gives us like targets up around 75.25, which is about 3 to 4% above where the market is now. So look, there's and that's not that's not as far as look, the market, we don't know. The market could come up, it could retest these highs up here. The local market does look like one of the best markets from the developed market suite of indices. It's the ASX 200 and the Canadian market are probably two of the standouts, and that's not surprisingly due to their concentration of resource-based stocks, and also the banking stocks in both markets have been doing quite well, and they're been really underpinning both of those markets, which we're not seeing in other developed markets like Japan, for instance. Doesn't have that resource sector, and it's been having some heavy selling, and of course Europe is in another situation altogether. So I think for now, I think we look for continued strength over the next few weeks, but we just sort of always keep monitoring. And again, I don't think it's a buy moment everything. I think it's a case of being very selective about what you get into. It's looking for stocks above their moving averages. It's not about buying those falling market favourites that have done so well over the last 2 years, because quite often you find that the leadership changes during these big corrective periods, and when we come out the other side, it may not be tech leading the charge anymore. So going out and buying your favourite tech stock, which has been hit pretty hard over the last couple of months, it may not be the play coming out of this and going into the next upcycle whenever that should happen. And so look, now let's go over and have a look at gold now. And just first, before we get to that, if you're getting some value from these videos, please hit that like button and maybe even please leave a short comment, because that's really helpful too, because it tells YouTube people are engaging with the videos. YouTube then shows more people watch, and I keep making those videos. So yeah, please give me that like, please give me a short comment, even if it's just, hey, like the videos, thanks. It really helps, so please do that. So over to gold. And okay, so gold. So last week we spoke about not chasing gold higher, and this is exactly why I don't like chasing gold and gold stocks higher. Because I spoke about last week about we're so extended up here above the moving averages, and I'm using, of course, 50 and 100-day moving averages. And I said something along the lines, the moving averages are a bit like gravity to a stock price, and when the market gets so far above those moving averages, it's like the moving averages of the gravity, it pulls it back down, and that's what we've seen. That's what we've seen in gold. Look, I think we're going to learn. I think we're going to learn a lot in the next. The next 1, 2, 3 weeks, next few weeks. I think we're going to learn a lot about what's going on with this market. So what we want to see happen now, we want to see the buy the dip traders and investors come in and really start to support the price down through this region here, around that that 1880, 1870 sort of level. Because as you probably heard me say a week or two ago, I said, look, my concern with this market is that this move has been very catalyst driven. It's been all about what's been happening I think mostly about what's been happening in Ukraine. And catalyst breakouts aren't my favourite breakouts. I like breakouts when you're kind of wondering, why is it breaking out? And then you figure it out later on. It's very obvious what the catalyst for this breakout is. So that's why I think it's so important that the market finds support down around this sort of region here, and we start seeing some buying interest coming in. So I want to go through a couple of scenarios about how gold could play out. So let's just so let's just set this up. So what we have at the moment, we've got we can say at the moment we've pretty much got a double top. We've got the high from July 2020, got the current high, got a double top. Now, that's not necessarily a bad thing. This can be good, because what a market will often do, a market will often come up, it will hit the point from the previous high, make that double top, and then you'll often find that it consolidates below the top, and then it starts to come up and have another crack at it, and then it's often away. That's often what you see around these double tops. And I think that would be the best case scenario for gold if we saw something like that. We see it well supported over the next few weeks, maybe the next few months. Maybe this takes 6 months to play out. Who knows? We see it well supported. It gets that builds a new underlying base, and then it starts to punch higher. That would be the best case scenario. I'll just give you a quick example of a recent pattern where something like that's happened. Saw something similar in uranium. I'll just get rid of that for now. Saw something similar in uranium. We had the big punch higher, then we got the consolidation, and now we're having like another punch higher. So quite normal for market to surge, come back. Gravity pulls it back to those moving averages, consolidates, and then goes again. So markets don't do a template of a previous move every time, but it's the sort of setup which I think, which I'd like to see in gold. I'd like to see this sort of pattern develop, and then we get our move higher. What the danger, I think, the danger. Let's go through a bearish alternate, and some people don't like alternates. They say, oh well, look, you just don't know what's going to happen because you've told us two views, but that's not right. People who say that they don't really get it, because it's about identifying your possibilities and then coming up with the strategies to manage those possibilities. So you've got to be aware of alternates. You've got to understand where you could be wrong. If you don't know where you could be wrong, well, how do you manage that possibility? So it's that's the whole point of these alternates. Now, there's also a possibility that now I was saying that this is a catalyst driven break. So the worry with a catalyst-driven break is, say things settle down in Ukraine, some miracle things start to simmer down, and we start to normalise, and then we get a case where gold starts to lose this momentum and pulls back down within the range, and we start getting liquidation. People who are bought on the basis that we're going into this big new bull market, they start to sell, and we get this move down like that. That is a possibility. It's a possibility I think you've got to be aware of. And if we look at it, but look, before you let that possibility freak you out, look at it from a weekly perspective. And this is how I'm viewing this. Look at it from a weekly perspective, and we've had this big move higher in gold. We've had this big move higher in gold over a 2-year period. This could all still be part of a larger consolidation. It may not be ready to go up yet. When gold goes, well, I should say if gold goes, it will go on its timetable, and we don't know the path that it's going to take to move higher. The move higher could still happen via 1600 for all we know. And I think over the next couple of years, we could well see gold up here at 3,000. But look, I don't know. No one knows whether the path is going to be from where we are now, and we're going to start making our way up now, or whether we're going to have another flush out, and then we're going to start making our way up. That's why risk management is just so important. So I'm long the gold market, and but look, it's not an all or nothing bet. It never is. It's never all or nothing bet. I know my alternate scenario, and I know the people who get themselves in the most trouble during these periods are the ones who they go all in, they pile in with a lot of leverage. The market doesn't follow the path they thought it was going to follow, and they do themselves a lot of damage. So I think that's why I think it's good to, we've got this breakout. We've got the breakout. I think it's important to sort of like go with this break, have our upside bias with the with gold just here now. Have this upside bias, see if we get support, and I think that's the way to run with this. If it doesn't play out, well, I'll be ready to close out some of my new positions if the price reverses. It's not like I'm going to get stuck holding on to my positions I bought during the breakout. I won't be holding them down here. I'll be out. And just quickly on the positive side for gold, you look at a stock like Newmont. Let's have a quick look at Newmont. Look, this has been being accumulated since back in December. So this isn't catalyst-driven accumulation. It has run a long way from its moving averages, and it might need to consolidate. Look at Newmont on a weekly chart. It's a very constructive weekly chart. It's I think the odds favour that this is not the all-time high in Newmont. It may well consolidate, but then I do think the upward trend is going to engage. The same when we look at the GDX Gold Miners ETF. It's look, again, I think we've got a good breakout here. It may consolidate, but I do think that upside potential is there. So I'm positive on gold. I think it's definitely a hold for those who have it. But look, I wouldn't be hurrying to rush out and buy new positions just here and now. I'd rather wait and see how the next couple of weeks pan out. See if we get that support coming in. Now I'll wrap up in a sec, but just briefly, I just had someone ask me about left a comment the other day about oil. It was a couple of weeks ago, and I just haven't had a chance to get to oil because there's so many other things to speak about. And it's look, oil has had it's had a huge run, hasn't it? And just looking at it over the last little bit, we've got this spike higher over the last few weeks. Let's go over to the 4-hourly chart, and look, that's sort of like what you call like a blow off top potentially, where you get this acceleration away from the trend, and then it peaks, and then it quickly gives back all those gains. So look, the trend in oil is definitely still up. I'm not getting negative on oil by any stretch. We could see it go higher, but the risk reward it's just so hard to manage your risk here. Like what is our upside target for getting long oil here? What's our upside target? What are we looking for oil to do? It's really hard. It's all so tied up around all the geopolitical movements at the moment. It's a tough one. So there's one which I'd prefer to, if I had oil in my portfolio, if it's long oil stocks, I'd continue holding them. I think the trend's great, but I don't really want to jump on this trend right here and now. Just looking at a stock like Woodside, for instance. So the time to have bought a stock like Woodside was probably around here. So the moving averages crossed, broke to a 70-day high. That's what I use. Could be 70 is not a magic number. It could be a 50-day high, but breaks to some sort of a high point. And my motion trader system actually gave a signal to buy Woodside in this region here. And now I think it's a case of letting it run. And if you again, it's just so extended above the moving averages. If I was long, I'd stay long with my trailing stop. I'm not in a hurry to buy it here. And if you're interested in the sort of signals I'm getting through my motion trader, algorithmic scans, algorithmic service, just jump over. Just for my YouTube viewers, I'm happy to give you a free 2-week trial. I'll leave a link at the top of the comments section if you want to come and check out the sort of signals that I'm able to generate through the market, through the algorithms. And yes, look, one stock which came up recently in the signals, which is interesting, Origin Energy. It's not an oil play as such. It's more gas. It's a natural gas play, electricity production, energy retailing. And look, it's an interesting stock because you got that positive moving average, so you got the positive trend. Prices pull back to the moving averages. Looks like it's starting to bounce. So it's a sort of stock which I think has the potential to continue to see that sort of price action develop. That's the sort of risk reward I like in this current market. This is the sort of stock I want to buy. Don't want to buy stocks which are in this mode, which are in their sell mode. I want to buy them when the price is above the moving average, and I see the potential to do that. So, okay, that's enough for this week. I've talked enough about markets. Hopefully that's helpful. Thanks for joining me. Thanks for tuning in. Really look forward to coming back next week, and let's have another look and see what's happened, what we think we can put together for the next few weeks in advance. So thanks for joining me. Until next time, I will see you then.